Welcome to this explainer on purchase price allocation. We're going to decode the financial architecture of global M&A deals to figure out exactly where the money goes. If you've ever stared at one of those massive multi-billion-dollar corporate buyouts and thought, wait, how does the math actually work behind the scenes? Well, you're absolutely in the right place. Today, we're taking you from absolute zero to deal-ready expertise on one of the most commercially significant concepts in all of transactional finance. So let's just dive right in. Picture this for a second. Imagine you just bought a neighborhood coffee shop for a cool $1 million in cash. You take a peek at the balance sheet and you realize the physical assets, the fancy espresso machines, the tables, the chairs, the coffee beans in the back, they're only worth about $300,000 on paper. So where on earth did the other $700,000 go? Did you just get totally ripped off? Or did you buy things that simply don't show up on a traditional balance sheet? Things like a fiercely loyal customer base, a neighborhood brand name everyone trusts, or maybe some top-secret roasting recipes? Now, believe it or not, this exact missing value mystery happens every single day. But we're talking about a massive, market-moving scale. Think about when big tech swoops in and acquires a hot new AI startup for, say, $5 billion, or a pharma giant swallows a biotech firm for $20 billion. Obviously, they aren't paying that kind of premium just for physical servers or lab microscopes. No way. They are paying for massive hidden value. But here's the catch. Regulators can't just let billions of dollars float around totally unaccounted for. So, to solve this multi-billion-dollar mystery, regulators and CFOs use a powerful decoder ring. It's called Purchase Price Allocation, or PPA. PPA is a strict accounting exercise mandated by global standards, specifically IFRS 3 internationally and ASC 805 if you're looking at US GAAP. Basically, it forces acquiring companies to take the total price they paid and meticulously assign it dollar for dollar across every individual asset acquired and liability assumed. It holds them completely accountable for every single cent spent. Okay, so let's really get into this. You might be wondering, why can't we just copy-paste the seller's old balance sheet onto the buyer's books? Well, the problem is that traditional financial accounting is built on what's called historical cost. And historical cost totally masks true market value. Like a Target company might own a factory they bought back in 1995 for $2 million, but today, it's worth $20 million on the open market. Or they coded software in-house for $500,000 that now generates $15 million in annual recurring revenue. PPA strips away these historical masks and forces a strict shift to fair value, meaning we measure absolutely everything at market rates on day one of the acquisition. So let's break down the PPA decoder ring and its 6 core pillars. To truly master these acquisitions, we've got to speak the language fluently. Pillar number 1 is purchase consideration. This is the total economic price paid by a buyer to gain control of a business. And honestly, it is rarely just upfront cash. It's cash plus stock issued, plus debt assumed, and crucially, contingent consideration, like earnouts that are tied to the future performance of the acquired company. You have to capture the entire economic promise the buyer is making. Moving to pillar 2, fair value. Now, in the accounting world, this has a very, very specific definition. It is absolutely not what you personally think a business or asset is worth. Instead, it's what a hypothetical market participant would pay for it in an orderly transaction. It's an objective, market-based measurement, not just a buyer's subjective feelings. Pillar 3 is net identifiable assets, or NIA. Think of this as the fully rebuilt fair value balance sheet. It's simply the sum of all of the physical, tangible assets, stuff like land and inventory, plus the identifiable non-physical assets, minus any assumed debts or liabilities, like loans or deferred revenue. Now for pillar 4, and this is where the real advisory magic happens: identifiable and tangible assets. To actually recognize non-physical assets on the new balance sheet, we're talking software, customer relationships, brands. They have to meet some pretty strict rules. They either must be legally separable, meaning you could literally sell or license them independently, or they have to arise from a contractual legal right. If they don't hit at least one of those criteria, they just can't be identified as a standalone asset. So when we put all those pieces together, we arrive at pillar 5, goodwill. Goodwill is basically the residual premium paid. It's a simple formula. Take the total purchase consideration, subtract the fair value of those net identifiable assets we just talked about, and boom, whatever's left over is your goodwill. It represents all those unidentifiable future economic benefits that you can't quite slap a standalone price tag on. Think corporate synergies, an incredible pre-trained workforce, or just general market dominance. And finally, pillar 6, the bargain purchase. This is also known as negative goodwill. And yes, negative goodwill is actually a real thing. It's this super rare scenario where you manage to buy a distressed business for less than its net assets are legitimately worth. Like if you pay $80 million for a business that holds $100 million in fair value net assets, that $20 million difference creates an instant day one gain on the acquiring company's income statement. Pretty cool, right? Okay, that's the theory. Let's head into section 2, the deal room real-world scenarios. We're going to apply this new vocabulary to 3 actual M&A scenarios to see how the math dictates the financials. First up, scenario A. This is a basic brick-and-mortar retail deal. Company A buys a retail chain for $100 million. Now, the historical book value of their net assets was only $40 million, but remember, we have to step that up to fair value. So, valuation advisors come in and appraise the real estate upwards by a full $20 million, bringing our tangible net assets to $60 million. In a basic retail deal like this one, there probably aren't any significant intangibles. So, $100 million paid minus $60 million in identified fair value assets leaves us with a straightforward $40 million in goodwill. Simple enough? Now let's level up to a tech deal and see how this builds. Scenario B, Company B acquires a SaaS software platform for $500 million. This is where identifying unrecorded intangibles completely shifts the math. Experts find a proprietary tech code base worth $150 million, plus customer contracts worth another $100 million. Add that to $70 million in revalued tangible assets, and our total net identifiable assets jump to $320 million. Subtract that from our $500 million purchase price, and we book $180 million in goodwill. You see how recognizing those intangibles just absorbs a massive chunk of the purchase price? All right, let's look at scenario C, which brilliantly illustrates a truly complex cross-border mega deal. A pharma firm is acquired for a staggering $2 billion. We've got $400 million in tangible assets, but check out these intangibles, a massive $800 million in in-process R&D and patents, plus $200 million for the brand alone. But wait, here's the catch. Stepping up these intangible asset values creates a gap between their book values and their tax bases. This actually triggers a massive deferred tax liability of $250 million. It's an unavoidable tax consequence of marking up those assets. Even after factoring all of this intricate accounting in, $2 billion paid minus the $1.15 billion in net identifiable assets still leaves us with a whopping $850 million in goodwill. Which brings us to our final section, the real-world impact. Just look at what happened across those 3 scenarios. If we just skipped this whole rigorous PPA exercise, acquiring companies would literally just book billions of dollars in arbitrary, unexplained goodwill on their balance sheets. Investors would be totally in the dark. Educating yourself about PPAs is absolutely crucial because it provides true financial transparency. It shows exactly what intellectual property was bought. It gets companies ready for those strict Big Four audits, and, most importantly, it directly impacts future earnings. Those identifiable intangibles we found get amortized over time, which directly lowers future earnings per share, while goodwill just gets tested annually for impairment. Basically, the way you allocate the purchase price on day one echoes through a company's financials for years to come. So we've decoded the structure of the deal room and the mechanics of purchase price allocation. But as we wrap up today's explainer, we're left with one fascinating mystery. How do institutional deal advisors actually use complex models like the multi-period excess earnings method or the relief from royalty method to mathematically conjure the exact dollar value of a brand or a customer list out of thin air? Well, that's exactly the mystery we're going to unravel next time. Thanks for joining me.